Today I will tell you what do the wealthy do in order to avoid losses in a volatile market. Now let's talk about the strategy they adopt to create significant long-term wealth and not get too bothered and disappointed by interim corrections in the market. First up, they avoid panic selling. They believe very strongly in riding out the correction. They are patient and they wait it out, which is the most important habit that you want to adopt if you are an investor. Emotionally being contained and of course mature and not losing your patience is extremely critical. Secondly, they usually have very diversified portfolios. They do not put all their eggs in the same basket. So they may diversify to other asset classes such as gold, crude, bonds, commodities. Some may who are wealthy enough or have some money may also look at real estate and other geographies to diversify their portfolio, because at any given time, a given asset class, or at least one asset class, is usually in a bull run. And what you want to do is achieve a portfolio return that is positive, manage risk as opposed to an asset class that is outperforming for you. Thirdly, they also adopt hedging strategies. Now, there are many ways of doing this, right? So if you have a long-only portfolio, you may want to consider adding a few shorts. You may want to consider buying some options. What you could also do is, if you don't have too much understanding of the options market, you could invest in a long-short fund. Long-short funds are usually adopted in a portfolio to reduce the volatility of the portfolio and contain the downside risk. What you can also do is use every weakness as a buying opportunity at lower levels. We often hear about how one needs to average out. If your view is long-term, remember that the interim corrections do not mean that the fundamentals of a given company have changed. So what you want to do is buy the stocks or invest in those mutual funds that are available 20% cheaper because there has been a price correction in the markets as whole. The very common saying that be fearful when others are greedy and greedy when others are fearful totally describes this, right? So you want to be greedy, you want to go out and buy when everybody is nervous, because remember, you are buying for the long term. You are buying to create significant wealth, which will of course be used as a passive income in the future. One of the important factor that every investor should do, retail or wealthy, is rebalance their portfolio. Now you can either rebalance at an asset level between equity and debt, or what you can do is rebalance your equity portfolio by sometimes selling off sectors or stocks that are looking very overvalued and using their money to increase allocation to sectors or stocks that are undervalued. So whatever has gone up too quickly might not be such a bad idea to take some profits off the table. You may also just take off the profits and keep the position running if you're still constructive about the given stock or sector, by ensuring that the corpus remains but the profits have been removed. Also, one other important factor is always keep a healthy cash balance. The very rich usually keep about 10-15% of their portfolio in cash, especially in market conditions such as this. What does that mean? That means that they have the 10% or 15% of money available to buy at every decline or at every dip. Sometimes we're not clear how long a correction is going to last. So in that case, they even stagger that 10% across a period of time to ensure that they get an opportunity to buy or average out at every decline that their stock or the market has been seeing. Very, very important is being emotionally strong. You want to avoid panicking, you want to avoid selling, you want to avoid leverage. Leverage works, but the fact remains that in a tough market, when things start moving against you, leveraged positions have to be given up by traders, and that's what makes things difficult for you. So largely that is a few factors you want to keep in mind. You want to be emotionally strong. Financial investing is not just about numbers and getting that right. It's about being disciplined, it's about being controlled emotionally and not giving in to panic.